Welcome. You're watching the Mutual Fund Show on NDTV Profit. I'm Tamanna Inamdar. This is the show where we give you all the information you need on your mutual fund investments and how to achieve your financial goals. Now, today's show is an interesting one where we're talking specifically about how to use mutual fund investments as a vehicle to plan your children's future, whether it's education, you want to set them up with a corpus or whatever it may be. But before we get into the details of that with our analysts and our experts, I want to just spend a few minutes on a news story which could potentially have a large impact for investors in this space. So SEBI has put out a proposal that there should be a new asset class that will bridge the gap between mutual funds and portfolio management services. My colleague Alex is joining in, mutual fund show regular, on what this really means. Now, first off, Alex, this is a proposal, so it has to go through, the motions to actually come into being. And it's interesting because it's looking for the investor who has more than, say, 5, 10,000, 15,000 rupees to invest per month and less than the one who has 50 lakh rupees in a PMS.
Yeah.
What exactly is the proposal and why does it matter?
So, while they've called it a new asset class, Tamanna, I'm a little leery about calling it an asset class because traditionally we've looked at equity, fixed income, gold as asset classes. This is going to be a vehicle to invest in the same asset classes that mutual funds and PMSs invest in, which is primarily going to be equity related. Now, to the point of who's going to invest, well, yes, it is targeted at individuals that have a higher risk appetite than can be served just by the mutual fund industry. But it's supposed to bridge the gap, as the regulators pointed out, between mutual funds and the PMS, the portfolio management schemes, and the alternative investment funds, which have a minimum threshold of 50 lakh rupees and 1 crore rupees respectively. Now, who can launch these products? As things stand, the proposal is for the mutual funds themselves to launch these products. They will fall under the umbrella of mutual funds and it'll be a pooled product. Why is this important? It's very important because portfolio managers have a bilateral agreement with each investor. So if you go to a portfolio manager, they'll have an agreement with you, you'll decide the fees, they will use a demat account specifically for you and they'll have hundreds of other demat accounts as well. Here, it's going to be a pooled portfolio where, like a mutual fund structure, you will have a trust that is managing this overarching business. Now, it's two aspects that are very interesting here, Tamanna, and why you could see a major shift in the way things are done. I mentioned the bilateral agreements in the PMS. They don't use derivatives very extensively because of this structure, because if they were to use derivatives, they would have to use that and then apportion the gains into each demat account, which is not very easy to do. What the new structure is suggesting is that you can have long-short funds, for example, where the purpose is to use investments for the long term, a long-term portfolio, but you also strategically use derivatives to gain in the short term.
Yeah.
Or you can even go short on certain securities.
So more flexibility.
More flexibility, more efficiency in managing because it's a pooled fund. And the fund manager just has to do on that whole basis and the unit holders get a share of the total. The second most important aspect on this is where AIFs could lose out is the taxation structure. Now, it's been discussed quite a lot and AIFs are currently taxed as business income, your gains from that, and it goes up to 42%. Now, if this is in the mutual fund structure, there is no reason, and we were talking to a few CEOs earlier today, one of them very specifically said there is no reason to think that this would be taxed as different from mutual funds right now.
Right.
And so therefore, equity taxation of 10% applies on long-term capital gains. And so automatically, you will have a taxation structure that provides a significant arbitrage, and you might actually have people moving up the value chain from mutual funds, but you might very easily see a lot of people migrating from AIFs
out of
and PMS.
AIFs and into and PMS as well. You structure down, move down. All right, so interesting times ahead. Thank you so much, Alex, for joining in. today and just putting that into perspective. We wanted to start with that because it's the big news story in the space that we wanted to address. But let's get back to the topic at hand, and I think one that is very, very important for everyone who has kids, is planning to have kids, or wants to, one way or the other plan for a little one's future. Arnav Pandya is joining us on this today. He's founder of Money Edu School, and Saloni Sanghvi, founder of My Wealth Guide. Both of them on the show with us today. Welcome to both of you, and great to have you on the Mutual Fund Show. Great to speak with you. Arnav, let me begin with you talking about mutual funds as a vehicle for this kind of planning. And if this new asset class comes into place, this could be one more avenue where you have a little more aggressive play, a little more time, and you want to actually build real wealth for your child's future.
So if you look at it in terms of building wealth for your child, the reason why a mutual fund is appropriate for this is because, one, that if you have a slightly longer time period, then you can have an entire portfolio created which helps the child in achieving multiple objectives over a period of time. So it's not just a question of one goal that has to be achieved. There could be a goal for education, wedding later on, plus even a corpus for some other purpose. So all these goals can be achieved through the medium of mutual funds. And the good part is that the very basic nature of a mutual fund, which is that it gives you access to a diversified portfolio, expert fund management, plus at a reasonable cost. All these things go on to cement the fact that the mutual fund avenue through multiple routes can be used for the purpose of planning for your child's needs over a period of time. And the longer the time period you have, the better it will be.
Okay. Obviously, the longer the time you have, the better it will be. Start early, I think, as soon as you know you are having a baby, I suppose. Saloni Sanghvi is joining us. Now, Saloni, the question over here is how much of risk to take with something that is so precious and so important? I mean, should parents look at lump sum investments? Should they look at a mutual fund portfolio? Should they look at safer debt options as well? What should the mix look like?
I think the biggest advantage here is that you have a longer time frame. So say if you start when the baby is born, you have at least 18 years before you would really need those funds. If it's for education, if it's for marriage or anything else, maybe 20, 25 years, right? So I think because it's such a long time frame, your risk, especially when you invest in equity, reduces. So I think given that parents can afford to be aggressive, parents can afford to look at, more aggressive portfolio, in equity, and even within equity, the different asset classes between large, mid, and small, you can definitely have higher allocations to mid and small as well, because you have the time frame and the horizon to, take that risk. I think also the benefit is that if you look at, longer time frame, equity is the only asset class that would be able to beat inflation. And today, education inflation is almost 10%. So, there are very few other asset classes which could give you the kind of returns, post-inflation that would help you to fund this.
Okay, so you need asset classes which will help you post inflation. Now, we've been talking about this from the point of view of an ideal situation, Arnav, where baby is born and excellently planned parents start putting in money immediately. That might not necessarily be the case. Let me hone in on one very clear need for saving up, and that is higher education. People may want to send their kids out of the country to study. Anyway, higher education courses are very, very expensive. If you have a time horizon of say 5 to 6 years, how do you then plan to maximize your wealth?
So the first thing which will happen is that if you only have a 5 or 6 year time horizon, then obviously the contribution that you would need to make would be far higher than what you could afford to if you had say even 10 or 12 years. So one is that your investments have to be far higher in terms of how much you are contributing to reach to your goal. The second part is that even for a period of 5 to 6 years, you will have to have a hybrid strategy right from day one, because in case of an educational requirement, you have to pay the fees on the day the fees have to be paid. You cannot at that point say that because, say, equity markets are low at this point of time, I'll pay it after 6 months or a year. So an element of a hybrid portfolio has to be there, because the debt part of it ensures that the closer you get to a goal, the more part of the portfolio you are securing in terms of the surety of the amount that will actually come in on the time or on the date when you want the fund. So that becomes a secondary aspect, and which is why it's like a double whammy, because see, the moment you have a hybrid portfolio and a higher allocation keeps going to debt, the overall returns on your portfolio keep coming down. And the moment that comes down, which means that to achieve a certain figure in terms of a goal, you will need to keep contributing more, and you don't have time for it. So this makes it a situation where a large amount would be required. And the third part is that if you are looking at, say, foreign studies for your child for their higher education, then you also got to factor in the point of the exchange fluctuation, which means that a part of your portfolio might even have to have some international exposure so that the currency fluctuation is taken care of. Because otherwise what happens is that inflation hits you, plus the currency depreciation which people face in India as compared to, say, the US dollar or even other currencies, that will make your goal seem even more distant.
So, okay, how do you have that foreign exposure? Give us a how-to-do list as well, Arnav. If someone's listening to this right now and wants to start, how do they do that? And especially on the part of, hedging yourself against fluctuation in currency. If you've planned for the next number of dollars, maybe 5 years later, that money just evaporates because of the currency movement.
Yes, so you have an option of various international funds which are there. Now, the thing is that not every international fund is open for subscription, because many of them have hit their limits in terms of how much investment they can take in. But having an exposure to an international fund, either through an ETF route or an active fund, if it is open for subscription, that is the simplest way an individual investor can ensure that they are taking on that foreign currency exposure risk. The other part is that even if a part of the portfolio is in something like gold, so and a gold fund, that also ensures that you not only have a diversification across asset classes, but also the gold price in India factors in that currency depreciation which is there. So these are two ways, but the simplest way to do it is simply have an international fund in the portfolio mix. While for the other funds which you have two options. One is that, see, there are specific child funds or children's funds which are launched by mutual fund houses. You can either go there if you do not have the expertise to actually manage a portfolio or create a mutual fund portfolio on your own. But one has to be very careful, because these funds have a lock-in of 5 years. So if, for example, you do not have that time period for your goal, then you will not be able to take out the money because of the 5-year lock-in. So if you are going in for a child-specific fund, then ensure that the time for the lock-in is taken into consideration. Otherwise, the easiest way is that, just like you invest in other normal mutual funds, have a mixture of debt and equity funds in the proportion that you actually want the exposure to be. And that is how you create this portfolio.
Let me take that question to Saloni. Now, what's the sort of starter kit for someone who wants to start, an investment, has X amount of corpus, or is looking at an SIP? What's the best way, and what would be the top 3 or 4 funds that you would recommend for such a person?
Obviously, if you have a 5 to 6 year time horizon, then, in terms of risk that you can take, that's limited. So in that case, I would recommend maybe looking at a multi-asset or a balanced advantage fund, which has a certain allocation to debt and to equity. And, as you go closer to the time frame, for example, if there's a year left to when you have to pay the fees, start moving some of those funds to debt funds, so that when you have to pay the fees, any variation in equity markets would not impact you. But assuming that, say, you have a longer time horizon, you have, say, 15 years or, anything above that, I would look at maybe ideally a 50, maybe a 40 to 50% in a flexi cap or an index fund. And the balance, I would break it up into a mid and small cap fund because there is a lot of time available and that risk can be taken in that time frame. So that is broadly how I would look at it. There are a lot of, there is a separate category for children's funds. It's a very niche category. But what we've seen is that, like if they look at over the last 5 years, it's given an average return of 16%, whereas FlexiCap funds have given a return of 21%. So I would say maybe preferably look at a FlexiCap or an index fund versus children's specific fund.
Okay. So a flexi cap or an index fund versus children's specific fund. I find that interesting because a lot of organizations push children's specific products and they're not necessarily doing the best for you. This question from Joy Naskar, who is aged 26, asks, what are your thoughts on the Motilal Oswal S&P 500 index fund? Is it a good investment? It's a very specific question. Arnav, let me start with you.
So this is an international fund and it's an index fund. So there is no question of the fund manager making an investment decision in terms of where the investment is going to go. So if you want an international exposure, if you want to ensure that you have an exposure to this kind of a market, then this is obviously a very good option if it fits into your particular portfolio. Because one, costs are low. Two, it gives you a complete exposure to a broader market as compared to what you call a narrow index. And if it's a requirement for your portfolio, it's a very good product in that sense.
So just tying back to what you were saying earlier, Arnav, where you were talking about, we were talking in the context of saving for your children's future, etc., and you talked about international exposure. Would a fund like that do the trick?
Yes, that would do the trick.
Okay. So, Saloni, let me take the question further. Of course, your view on this particular fund, which is the Motilal Oswal S&P 500 Index Fund, but also for those who want to have some exposure to the US markets. What is a way to do that?
I concur with Arnav. It's of course great to diversify geographically, and especially given his age, he is able to take that risk. But I think if I had to pick an international fund, I would prefer looking at NASDAQ, for the simple reason that it gives you exposure to many sectors that we don't have access to in India, like, EV, social media, and a big pharma, variety of such sectors, which again in India, we don't have companies that are listed or investable in that space. So I would recommend maybe looking at a NASDAQ-based fund.
Okay, especially, right now when tech is hot, I mean, right now going through some rotational play, but if you want exposure to an NVIDIA, what other way is there? All right, Srinivas writes in, who's aged 50 years, the goal is retirement fund, says, my father has a retirement corpus of 25 lakh rupees to invest in different instruments. Can you suggest a few funds? So there is already 25 lakh rupee corpus, which is available. What are the instruments that you would suggest? Let me come to Arnav with that question first. Arnav, were you able to hear the question?
Yes.
Okay.
So 2 points here. One is that the corpus, there's a lump sum which is already available. Two, but it is for his father, which means that who's retired. So I presume that details have not been given, but that safety should be a priority as far as this investment is concerned. Because information is not given as to whether a regular income needs to be generated out of this or not. So if I'm giving a solution in terms of if there is a part of the portfolio which needs some sort of generation of regular income, then there are options in terms of a senior citizen savings scheme where some investment can be made. So the proportion has to be in terms of how much income needs to be generated. Then there are debt funds which are also available. And if say the person is around 60, 62 and they plan to invest for a longer period of time, then a hybrid fund which is conservative in nature can also be part of the mix, because what that will do is that it will give a little bit of equity exposure, which can bump up the yield a bit, but the risk is contained. So this is the kind of portfolio which can be created with the exact corpus, depending on how much of it needs to be just kept aside and how much of income needs to be generated.
Okay. Let's quickly take one more question before we have to wrap up for the day. Rajat Mishra, age 56, writes in, says, I have a SIP of 50,000 rupees in Parag Parikh Flexi Cap and 25,000 rupees in the Nippon Small Cap Fund. Additionally, I want to invest 2.5 crores and retire in the next 2 years with a regular source of income. So should I invest 2.5 crores as an SIP or as a lump sum investment, and can you recommend a few funds? Great question there coming in from Rajat. Saloni, I'll start with you to tackle this one. There's already an SIP going on of about 75,000 rupees combined in those funds and a lump sum.
First off, it's a little difficult to recommend the right asset allocation without knowing Rajat's risk-taking ability. But he's mentioned that he will start withdrawing funds after 2 years. He's looking to retire in 2 years. So I would recommend keeping at least 1 year of expenses in a debt fund or an FD, which can be tapped when he retires. Another 2 years of expenses can be invested in multi-asset or balanced advantage category. So that can be the second bucket to tap once this is, this is over. And then the rest of the funds can be invested between two funds, maybe across an index or a flexi cap category. In terms of the funds that he is currently doing an SIP in, they are good funds, but Rajat, just keep in mind that small cap as a category is more volatile, and you would need a higher risk appetite, for investing in it and for holding in it, especially after retirement. As to whether to do a lump sum or SIP, I think the amount, the 2.5 crores, can be invested over a 3-month period, either via an SIP or an STP from a liquid fund for the equity fund. For the other debt funds, that can be directly invested as a lump sum.
Okay, so go SIP for equity, lump sum for debt. And best of luck with everything. All right, that's all the time we have on the Mutual Fund Show on this episode. Arnav, Saloni, always great to have you on. For our viewers, thank you for joining in. Numbers on your screen if you want to reach out to us. But that's all the time we have. Stay tuned, a lot more coming up on the other side.